So after the market closed, it looked like that I lost money, but I actually profited today, and it was $2.71 in the after hours, meaning after the market was closed. I have profited $2.71, or actually overall I profited $1.72. So to get to my portfolio, I own eight shares of Ford, 2 shares of GM, 1 share of Bank of America, 4 shares of Reynolds in American Incorporated, and the majority of these stocks, if not all of them, are the reason why I invested in these stocks is because of their dividend, and these companies are staple companies, meaning they'll be here for a while. More than likely, in the next 1 to 2 years, they'll be here. And I'm a long term investor, so I'll be with these companies for a while, and I'll get their dividends. And they have a fairly decent dividend. For Ford, they have a 5.38 yield per year, so 5.38% goes back to me, whatever I invested in Ford. For GM, they have 3.89% dividend. Bank of America, I think, is the smallest of all. Only have 1 share, 1.38%. And then Reynolds American Incorporated has a 3.43% dividend yield. And that was I want to get to talking about staple companies and their interest in the market right now. Because as of the market is growing pretty well, and most of the companies, including staple companies, are overvalued. And the reason why I'm buying is because I don't think they're reaching the tipping point yet. I think in the next year there'll be a time to sell. And the reason why is because dividends are high, and PE ratios are high. And let me show you an example. Campbell Soup Capital. Campbell Soup Capital is known for their soups. I'm pretty sure you heard of them, and if you look at their PE ratio, it's 26.81, meaning people or investors are willing to pay around $27 to earn $1 profit. See, that's kind of weird because that's typical for growth companies and tech companies, because usually these companies have something they're going to expand into, whether it be a new product or just something new that will keep them growing and consumers will like and so forth. But Campbell, I mean, they're not going to make a new product. They're just going to keep their traditional soup. And if you look at their dividend, it's around 2%, around 2%. And that's decent compared to other companies. And if you look at the 10-year bond yield, it's around 1.5%. So for investors, that's lower than most staple companies have, and people are buying into these stocks. So they're looking for high PE ratio. If you look at high PE ratios, they're gonna have a decent dividend. And when you see the 10-year bond yield be closer to 2% and or 3%, that's when prices are going to drop. That's when the overvalue of a company is going to reach its limit. So that's what I just wanted to share today. So if you really want to ride this, buy staple companies. So like Ford, GM, Bank of America, Reynolds American Incorporated. I bought Reynolds American Incorporated because it's looking well. In the short term it doesn't, but like in the long term it does. It over the past year it's been growing. Over the 5 years it's been growing. It's a slow growth. I mean, over the past year, it only increased $6, but if you include its dividend, that is not bad. So today, it's actually reached its support at $50-ish dollars. In May, it was around 49, and we just reached that low. Hopefully, it doesn't reach 48, but who knows? There'll be a new support line, maybe around here, 47, 48, and then. But hopefully by tomorrow or the next week or so, we'll see it bounce back up. So that's all I wanted to share with you guys today. I'll see you guys next time.